So while you're dropping that in, we're going to go over our agenda. And small businesses, and really any business, is you face a lot of tax issues in any given year. Some are simple, some are complex, some require really detailed calculations and analysis. So you as a business owner, you as a business consultant, you as someone that's interacting with an organization, whether it's a daily or weekly basis, you need to be highly aware and cognizant of what questions to ask and how to make sure your business is aligned appropriately and you're taking advantage of the tax code as it is written for that time period. Again, overall disclaimer to today's webinar, the tax code is ever changing. It's a landscape that's never going to stay the same. So anything we talk about today is subject to how the rules are in today's current tax environment. And it's super important to stay mindful of those changes, but also that is why it's so critical to have such a good relationship with your outside consultants, your attorneys, your accountants, people that you trust in your business, so that you are always going to be able to be made aware of any of these changes and how they impact your organization. So today, we're going to talk about home-based business tax issues. We're going to then look at business tax deductions for small to medium businesses and how those are going to help you reduce your tax bill, looking at both specific line items as well as how retirement plans and health insurance programs are going to help you lower that tax liability on an annual basis. Now, I know everyone's probably thinking, oh, I know what tax deductions are available to me. They're just my business expenses. We're also going to look at those top 15 or 20 business expenses that you have in pretty much any organization and how those translate into real tax deductions for you and your business. Again, bringing that bottom line down from a taxable perspective. We're also going to talk about, with that 2020 tax law that was signed in December of 2020, which pieces extended into 2021 so that they're on your radar as you finish out this last quarter of 2021 and move into filing your 2021 tax returns, which is going to be here before we know it. We're also going to cover the considerations and tax implications surrounding buying and selling a business and any merger and acquisition activity. And then we'll conclude with a wrap up of the key point high level takeaways that I think are the most critical for you to take away with you after you leave this webinar, and leaving some time at the end for, hopefully a nice, good, engaging Q&A session. So home-based businesses are going to be eligible to deduct all those normal tax deductions that are available to any other business. Examples would be, office supplies, software subscriptions, travel expenses. But if you don't have these on your list or on your radar, you may be forgetting some things. Maybe that box of pens that you bought, maybe that was only $5 and you totally have forgotten about it. But those $5 business expenses can really add up and make an impact to lower your taxable income on an annual basis. Also, home-based businesses could be potentially eligible for a home office deduction. And we're going to do a really deep dive on that deduction here in the next couple slides, thinking about 2 or 3 slides, to check on eligibility, limitations, and how those calculations all work and what you could be open for. Essentially, though, a piece that I really want you to think about is details and records are so critical to maintain when you are looking at business tax deductions, and you need to understand thoroughly the categories that are available to you as tax deductions and tax credits. If the IRS comes knocking for an audit and you don't have good, clean records, they're probably going to call into question things that are completely legitimate and completely correct and accurate business expenses. So if I don't say it throughout the webinar, but you'll probably hear me say it at least 5 or 6 times, make sure you are keeping a nice, clean, good record of any business expenses that relate to your organization. And also hand in hand with that, this again is why it is so critical to have that strong relationship with your tax accountant to make sure you are handling your business expenses and tax deductions and credits in the most appropriate manner for how your business organization is set up and industry specific items too. And with that, It's going to be time for our first poll question. And Anna, I believe you pull up the poll questions. If that's not true, let me know. But
it's okay. Sorry, you can actually pull them up on your end, Noelle.
Okay.
Just at the bottom, it'll say launch first poll question.
Okay, so I need to just end there. Oh no. It is not. See, remember we talked about how it's so much easier when you're not.
It is. You know, we come away from these webinars sometimes and come back and the technology frazzles us a little bit.
Yes, yes, it has been a while since I've done one of these. Okay, so poll question number 1. How many of you operate a business out of your home? So you go ahead and select the radio button that most applies to you, that yes, my home is my principal place of business. Yes, in addition to other locations I might have, or no, my business is operated at a wholly separate location, 100% out of my home. And we're going to wait till we get a few more responses, give everyone a chance to respond. Again, this just gives us a good mix of who's all on these webinars with us. And I'm just going to go ahead and say end poll so that the results can be shared. So it does look like more than half of everyone on this call does operate a business directly out of their home, and that is, you know, their principal location. A few have some home-based business operations, and some, you know, you're working completely out of the home. So excellent. So we'll close this. I'm actually going to move this to this screen. We're just going to start moving some stuff around here. And then I will get the presentation back up. Okay, and we were here. Okay. All right, so as I mentioned, we're going to be looking at some most common small business tax deductions. And a lot of these you all probably are very familiar with, but some you may have been neglecting to consider that, yep, that is a business tax expense and I should be eligible to take that as a tax deduction on my filings. So I wanted to kind of get this list in front of everyone, go through kind of line by line what we mean by each of these, what good examples are, and what could be included in each of these categories. Because a lot of times, even though these seem so common and so just routine, a lot of businesses neglect to include these on their tax filings as deductions. So the first one we have on this list is startup and organizational costs. Now, business startup costs are seen as a capital expense by the IRS because they represent an investment in your business. So you haven't actually paid cash out the door for a good or service, so that money hasn't left your business. It was simply transformed into an asset. But there is still a tax deduction available to you related to these costs. These deductions will typically occur over a period of years, and you will take this deduction as amortization expense. But recording these costs and related amortization is going to help your business assess profitability accurately year over year, as well as allow your business to take a deduction if you have these organizational or startup costs for your business. The next one is inventory. So an inventory-based business, if you're manufacturing products or purchasing them for resale, you can deduct the cost of your inventory, or in other words, the cost of the items or goods that you sell. Now, you need to make sure that you have a good, strong, solid value of your inventory, both at the beginning of your fiscal operating year, as well as the ending of your operating year, because those are going to be necessary to calculate your cost of goods sold. And in the accounting world, we love our acronyms. So we call cost of goods sold COGS. So I'm probably going to call it that the rest of the webinar. So you need to understand those beginning and ending inventory balances, as well as all of the goods and inventory purchases you've made throughout the year. And some examples of the expenses that would go into this calculation would be that actual cost of the raw materials or goods. including freight. What did it cost for those raw materials to get to you? The cost of the storage of those materials, any direct labor costs for the workers who produce those products, as well as factory overhead. So these are going to be costs related to the actual manufacturing of the product, excluding that direct labor. So factory maintenance, equipment rental, essentially things that sit on that production floor that help you turn those raw materials into the finished goods that you ultimately sell to your third-party customer. Next one, utilities. Seems like a really simple, easy, basic one, but you'd be surprised at the number of people that neglect to include utilities as a tax deduction. So this is everything: water, electricity, sewage, telephone, internet. Pretty much if you're using a service to help support your business and you are paying for those utility costs for your business, they are a tax deduction. Insurance. Usually insurance expense is a really big number for any organization. There are so many insurances you can have for your business. And if you're paying those to insure either real or tangible property, so buildings you may own, automobiles that are owned by the business, workers' compensation, malpractice insurance, liability insurance, business interruption insurance, these are all legitimate business expenses and are 100% tax deductible on your returns. Rent, another easy one that you would think, and you'd be surprised at how many times you just forget you're paying those lease or rental payments for that storage shed or for that vehicle. If you're using it for the business, now again, you want to keep in mind, it needs to be 100% used for the business for it to have a tax deduction equal to 100%. But if that storage unit, you're using 20% or 50% of it for the business, that percentage is going to be able to be deducted from your business income, reducing your overall taxable income. Depreciation. So any buildings or equipment that you own and are an asset of the business, those are considered capital assets. You're going to be eligible for depreciation expense. And in the tax world right now, there are two distinct programs that will allow you to take depreciation expense as a one lump sum. There's bonus depreciation that's going to allow that 100% deduction of eligible capital assets in the year of purchase. And there's also Section 179 depreciation that's going to allow year of purchase full deductions of up to approximately $1 million of equipment. Now, there are definitely limitations and other calculations to be aware of with both of these depreciation programs from a tax perspective. And there's just not enough time to cover all that in this webinar. We could probably do a whole webinar on just tax depreciation models and how that all works. But you definitely want to keep that in mind. And if you have specific questions about it, maybe there's going to be time at the end of the webinar for us to dive deep on it. Or again, these are prompts to help you to know what questions to ask your tax accountant as you're finishing out your calendar year and getting ready to file your next year's returns. Now, keep in mind, depreciation is similar to amortization, where the expense is spread out over the useful life of the asset or over a certain number of years, but it's still giving you that tax deduction.
Well, I was just going to jump in and mention, you can agree or disagree. I've worked with a lot of accountants, over the years, and just like any kind of a professional, some are more thorough than others, right? And so if you're working with an accountant, I think Noelle's slide here is something good for you to have handy, because you can't necessarily count on your accountant to ask you all of the questions that will help you uncover what expenses you have as that you could be using as deductions, right? So you may want to keep this available and, be a little bit more collaborative with your accountant. Hey, here's some information that I have. Can these be used as deductions, right? To sort of help them out.
Yep. Great point, Mike. Thank you for jumping in on that. Yeah, this definitely, any of these slides that you may think would be a handy reference tool, we can certainly provide, bullet points, handy cards, just again, we're here to help whenever you need. I've said this on probably all of the webinars I've presented for Fiffik, but I love accounting. I will talk to you about accounting whenever and wherever. So I will never be bored by it. I will take and welcome any questions. All right, next on our list, office supplies and furniture. So the paper, boxes, printer ink, pens, desk organizers, desk chairs, all of these are purchased for the use in your business. So that's an eligible tax expense or tax deduction, I'm sorry. Now keep in mind, as a business, you should have a capitalization policy. And what I mean by that is if something is over a certain dollar amount, usually about $1,000 or $2,000, and you expect it to have a greater life capacity of more than 1 year or 12 months, that is technically considered a fixed asset or a capital asset, which means you're not going to be able to necessarily expense it all in one fell swoop on your tax return, but it would be open to that depreciation, which you could be eligible for bonus or section 179, but definitely want to keep that in mind too about a cap policy and having that as part of your business structure. Software subscriptions. If you've purchased or downloaded software like credit card programs, accounting software, or customer record management programs for your business. Now, again, these may have a capitalizable component if you have purchased software outright for a large dollar amount and you own that license for it. Again, you want to be discussing these specific types of questions with your tax accountant to make sure you are capitalizing assets appropriately and taking the appropriate tax deductions related to it.
Noelle, everything is in the cloud now, right? I mean, it's all subscription based anymore. Is the service sort of recognizing that as deductible, because we all have, or many people have, Office 365, and maybe their phone system is a cloud-based system, all of those, everything's in the cloud these days, right? Those are all what we considered software subscriptions for purposes of deductions.
Exactly. So that's all considered software as a service, or SaaS. Again, accountants love acronyms. So you don't actually own that software. You've been given a right to use it for as long as you pay for your subscription. And since your business wouldn't own that software, that is just a monthly expense, like your utilities, like your rent, because it's not something you in fact own that you would need to worry about capitalizing and depreciating.
Okay, so it's 100% deductible in the year that you pay.
Exactly.
That's a good thing.
Yep, absolutely. Now we're going to move on to advertising and marketing, billboards, business cards, advertisements. If you hire a graphic design consultant to design your logo and brand, anything that you are using to promote and endorse your business to gain new customers or looking for vendor relationships, all tax deductions. Business entertainment, when you are entertaining clients with meals or events like baseball games or dinners. Now, some of this is only going to be 50% deductible or not deductible at all for tax purposes. But if you're maintaining receipts and records, noting the event, who all attended the event, and the purpose of the event, it's going to help you maximize this deduction. You definitely want to have the conversations with your tax accountant on which pieces of my entertainment are 100% deductible, 50% deductible, and 0% deductible.
I'm going to go out on a dangerous limb on this particular issue. But anyway, if you're a small business owner, sometimes somebody may raise this issue with you that you may want to add a spouse or a family member as a minority owner of the business. There might be some reasons why you can pass some profits to them that aren't subject to payroll taxes, wage taxes, those types of things. But if they're an owner, it may also help you increase the amount that you can write off, right, for entertainment, right? If you're going out, you and your spouse or your significant other or whatever it is, if you're both owners, even if it's just a 1% owner, perhaps that expands that. Again, I'm going out on a dangerous limb there. Noelle can talk about that if she wants.
Business entertainment is a dangerous limb. So you're absolutely right. If your spouse or significant other is part of the business in your structure, that's going to help. But it can't just be, hey, my spouse and I went out for our anniversary dinner. That's not going to be a legitimate business expense.
You don't think that happens at Valentine's Day dinner? You're not talking about business with your spouse? I mean, come on.
It's definitely going to be a lot easier to explain away, September 20th lunch where you discuss, and that's also where key documentation comes into play. If you've documented exactly what you've talked about and the purpose of it, that's going to definitely be a factor in your favor because the IRS, again, they keep talking about they're going to raise the thresholds on audits and more people are going to be audited. Who knows if that's going to happen? They're really hurting for agents right now, but definitely want to keep that in mind as we're going through this list. You don't want to do anything that may put you in jeopardy of having that audit and not being able to substantiate all of the deductions you have taken. Travel's also on here, airfare, tolls, taxis, essentially any expenses you've incurred to travel away from your primary place of business to conduct business elsewhere, all business expenses and tax deductions. Interest, if you have a small business loan, you're making interest payments on what you borrowed from the lender. These interest payments are typically going to be fully tax deductible as long as that loan was incurred to cover business expenses. Now, to claim this deduction, the business owner must be legally liable for the debt, and the business owner and the creditor or the lender must have a traditional debtor-creditor relationship. So in other words, that loan has to go through a traditional lender. It can't just be that, a friend happened to loan $1,000. You definitely want to have the correct paperwork drawn up to show interest rates and payback terms and everything like that.
Yeah, I was just going to mention that. We just did a promissory note and a mortgage. Dad helped son buy a property and we documented that transaction for that very purpose.
Yep. Again, documentation is always going to be key and critical, anything we're talking about here. Bad debt. So if you've ever lent money to an employee or a vendor without receiving it back, you can claim that as bad debt. Now, this assumes that you've claimed that as income in a prior filing. Otherwise, you won't be able to claim this as an expense. But the IRS has a big, long, wordy definition of what bad debt is. And we're not going to talk about that right now. But examples of this would be essentially, loans to a client, supplier, distributor, or employee. Essentially, you give credit terms to one of your suppliers or to one of your customers, and they haven't paid you yet. A business loan guarantee, these types of issues where, again, you've given cash out of your business for a business related purpose and that cash was not received back into your business, you can write that off as bad debt. Taxes, another deduction for some taxes. So you're going to be paying sales taxes potentially, or the employer portion of payroll taxes. These are all business expenses and tax deductions. Salaries and benefits usually makes up the majority of a small to medium-sized business if you have employees. So any wages or employee benefits that you're paying to your employees, including any commissions or bonuses. Now keep in mind, this would not count if you are a sole proprietor, a partner, or an LLC member, because those individuals are not considered employees. You're considered an owner. Contracted labor, so an independent contractor, freelancer, gig worker, essentially someone that you have paid to do some type of work for your business, but they're not an employee, so they're separate from your organization. These are going to be the people you issue a 1099 NEC to every year if you pay them more than $600 in a calendar year. Mike?
Before we get to my favorite deduction, I just wanted to mention, and this is maybe a little bit off topic, but we're talking, it falls within these categories, right? I always encourage business owners, it's important for them to understand they don't have to reinvent the wheel, right? They don't all have to reinvent how to run and operate a business all by themselves. So, my firm is available. Donnelly-Boland is available. They have experience with a lot of businesses, right? They can bring all of that experience to bear to help small business owners get much further ahead without making a lot of mistakes a whole lot faster, right? And one of the things that I find particularly helpful that organizations like Donnelly-Boland can provide is having a good understanding as a business owner what your ratios should be when it comes to your expenses. If you're running a restaurant, what percentage of your monthly expenses should be spent typically on inventory? What's normal? Because it'll help you figure out whether you're spending too much money on your inventory. And the same with your salaries and benefits. You know, there are going to be some conventional wisdoms for well-run businesses in different areas that will say your ratio of your inventory should be, 30% or something like that. Your labor should be 20%. To just give you kind of benchmarks to figure out whether you're spending too much in one particular area, and it might help you hone in on something that you got to spend a little bit more time on to end up being more profitable along the way. I don't know why I thought about that. I'm sorry if it's totally off topic, but it really helps. You should be asking your accountant, am I spending too much money on inventory relative to all of my expenditures? It's not just a deduction question. It's really am I running my business correctly question? Is there something that I need to be looking at on a going forward basis to make myself more profitable along the way? Your accountants should be able to help you with those things. And if they aren't, you need to find somebody that can.
Exactly.
Sorry to cut in, Noelle. We actually, while we're on the topic of deductions, we have a good question for you. And I already have some saved for the end for you as well.
Okay.
But Jimmy in the chat asked, is there a dollar limitation or a percentage for business entertainment and business meals that can be deducted? And then what is the best way to document said entertainment and meals?
Okay, gotcha. So there's not really necessarily if you do 100,000 in sales each year, then you can only have 5,000, 5% of business entertainment expenses. It's more, as Mike was actually just mentioning, that's a perfect segue from Mike's comment to this question. It's more thinking about what is kind of industry-wide going on. Obviously, if you're only having 100,000 in sales and then you try to deduct 60,000 of business entertainment expenses, that's going to raise a lot of eyebrows because that's 60% of your revenue. So you kind of have to think about what business industry are you in and what type of clientele are you pursuing and what is typical for your type of business industry and business stream, while keeping it in a good range of either a percentage of revenue or a dollar amount. And again, even if you're within that range, there's going to be some things that just aren't going to be deductible, or they're going to be limited to the 50% deduction from business entertainment. As far as what type of documentation is best, the receipt, and right on the receipts, and I know so many people have electronic receipts now. So if you have a picture of your receipt or you're getting a PDF document of your receipt, putting a sticky note within PDF, or if it's still a paper receipt, flipping it over and writing on the back specifically who was all in attendance, their relationships with you, whether they're part of your business, a potential client, a current client, a vendor, a potential M&A interest, whatever it happens to be, as well as a description of why you met, what was discussed. You don't want to give away business secrets or anything on the back of this receipt or in that sticky note in the PDF, but being as thorough as possible so that anyone that would be looking at that from an audit perspective could totally see the legitimate reason behind you as a business owner, other business partners or employees that are with you, meeting with these particular individuals and discussing these particular individual topics and why it was a necessary business expense and tax deduction.
Thank you.
Yeah.
Perfect.
Okay. And the last one on this list, as Mike mentioned, it's his favorite. So if you engage in legal and professional fees, so any attorneys, accountants, or any other professional organization that has been hired by your business to assist you with your business needs, again, tax deductions, business expenses, they are deductible. So hire but work with good ones. Don't find the slimy ones. Accountants, I mean, because there's some of us. It's a shame, but there's a lot of accountants in jail. Don't find those ones. All right, so I know we spent a lot of time on that slide, but that is, to me, is just so important to have those on your radar. And as Mike mentioned, having that as a tool in your back pocket to discuss those so that they're not being missed when you're looking to do your tax filings on an annual basis.
Sorry to cut in again, Noelle. I
That's
just
okay.
wanted to, while we're on the subject, we just got another question that I think is good and specific to it. But somebody asked, are premiums paid for a subscription legal plan deductible? And let me know if you want them to elaborate a little bit more on that, but
It sounds like they would be. Mike, maybe you have a little
see
more
Mike cutting
information.
it.
Yeah.
Yeah, well, this is a question I had too. I would imagine if you can write off professional fees, then I would imagine the subscription service that gives you access to professional services would also be deductible.
Yes.
I would have to think so. I don't think
Yes.
there's any doubt that it would be, deductible. The one question that I would have, and I don't know whether you can answer this now, but so Legal Shield sells a product that is a business plan for home-based businesses that is only available, and any associate on the call can correct me if I'm wrong, is only available if you first have their family plan, right? Their family plan. It's attached to it. It's like a rider, so to speak. I would think that it would make the whole thing deductible, like the combined premiums. But I don't know, right? Because you can only access those benefits if you have the family plan first. It's a rider to that. What would you think?
Yeah. I'm with you on that. I can't see any reason you'd have to split those out because one depends on the other. And they both sound like, and the whole package, I should say, sounds like a legitimate business expense and 100% tax deductible.
Great. So I don't know if anybody has covered that ground in the past, if you're associates out there, but that's a little takeaway.
Excellent. All right, so let's talk about the home office deduction. Well, what is it? That's where taxpayers can claim a business deduction for expenses related to a qualifying use of all or part of a residence for business conducted in the home. Now, there's 4 potential eligibility requirements, and you have to meet one of them. The home must be one of the following: either your principal place of business, a place where you meet patients, clients, or customers in that normal, ordinary course of business, a separate building not attached to the home where ordinary business is conducted, or if the home is the only fixed location of the business, a space where you use to store inventory or product samples. So if you hit any of those 4, you would be eligible to claim this home office deduction. Now, a total side note on this that I want to make sure I'm very clear on: unreimbursed expenses of maintaining a home office are no longer deductible on your personal Schedule A from your 1040 as part of that miscellaneous itemized deductions, because the Tax Cuts and Jobs Act suspended that for tax years 2018 through 2025. Again, that's all subject to potential change, but right now, if you're an employee who works from home and you may be required to maintain an office space for your work you do from home, so you're not necessarily a business owner, this does not apply to you, and you also cannot take the home office expenses on your Schedule A. This is something separate. Now, calculation of the home office deduction was simplified about 5 years ago, which streamlined the calculation, made it a lot easier. Simply take that allowable square footage of your home that you use exclusively for your business, but now that can't be more than 300 square feet, and you multiply that by $5 per square foot. That's it. Now keep in mind, this deduction cannot exceed your business's net income, and you're not going to be allowed to carry this deduction over into future years. And as part of this, you would report this on your Schedule C of your 1040. Now, you can still elect to use the full calculation method, where you're still going to calculate that percentage of home you used for your business, but then you determine all your actual home expenses, utilities, taxes, insurance, etc. And again, keeping records of all of those. And then you multiply the percentage of your home office by those actual expenses to determine the balance of your home office deduction. As with the simplified calculation, this deduction cannot exceed your net business taxable income. However, if you elect the full calculation, you can carry forward any amount in excess into future years, unlike that simple calculation. Now, for this one, you're going to have to complete a whole separate form called Form 8829. All right, so we covered kind of the most common business expenses that could be tax deductions for you. We talked pretty in depth about the home office deduction. And Mike, I see you popped up. What's up?
Well, yeah, before you get into the retirement plans, I just had a question about the deduction. I would imagine this is something that a lot of people are going to be doing it for 2021. And I mean, did you have an increase in these? I presume for 2020 when you guys were doing taxes?
Yes.
Yeah,
Yes,
I would imagine.
there was a significant increase in these, and we expect that to continue. In addition, not only did we see this increase because of COVID and everything else, but because that miscellaneous itemization went away from Schedule A, a year or two prior to COVID, we were already experiencing an upswing in that deduction. So this just carried it even higher.
So I would imagine this is going to be, if it were ever a red flag, if it were on a return, it's much less of a red flag at this point. So it may be easier to really get this through, right?
100% agreed. Yeah, they're going to be seeing this on a lot more tax returns. So it's not going to be that, like you said, that red flag, that hot button item that would trigger an audit as it would have maybe 10 years or so ago.
And it's not unusual to claim it in one year, but not in another year necessarily, because your work situation can change. Kind of.
Exactly. Yep.
Awesome.
So again, those are all good points to bring up. And so, yeah, definitely don't not take advantage of that deduction in case you thought it was still, a red flag for an audit, because it doesn't trigger nearly the way it used to many, many years ago. All right, so retirement plans. This is a fabulous benefit program to put in place for either yourself as the business owner or for your employees. It's going to help you, again, lower your overall tax liability while providing a really good benefit program, again, for yourself or for employees. There's going to be several retirement plan options out there for small businesses. Some of these are only going to be good for just the business owner, while others can benefit both current and future employees. The first one we have on the list on the slide is a solo or self-employed 401k. Now, this is only going to cover the business owner or the business owner and the spouse, but it is going to allow you to contribute as both the employer and the employee to be able to take advantage of those higher contribution thresholds. Now, we definitely don't have time today to go into detail of the different thresholds and all the pieces. Just wanted to get the names of the retirement plans out in front of you. Again, this is a nice handy resource kind of cheat sheet. Like, hey, do I have a retirement plan? Can I pick one of these options and have deeper discussions either with those of us at Donnelly-Boland, with your Fiffik and Legal Shield group, with another business consultant that you trust. Just want to make sure you're seeing all the potential avenues that are available to you. Another option is the SEP IRA. So this is a simplified employee pension. This is going to be a better choice for either a self-employed individual or a business owner with no employees. These plans can get really prohibitively expensive once employees start coming on board. But this type of plan can provide a significant source of income at retirement. There's no startup costs. The operating costs of this type of plan are usually a little bit lighter. So this is, again, a good option if you have the cash and want to have a strong benefit program for you as a business owner or for if you have a handful of employees. Another option is the simple IRA. So that's going to be your savings incentive match plan for employees. This is going to allow both employees and employers to contribute to an IRA. And this is going to be best for those small businesses to start a retirement savings for their employees where another plan just doesn't currently exist. Now, keep in mind, if you elect to have a simple IRA as the retirement plan for your organization, you cannot have any other retirement plans for your organization. Again, lots of calculations on elective and non-elective contributions. So if this is something you're interested in, we can certainly do a deep dive on this offline. And finally, there's always going to be that traditional IRA or Roth IRA option. The first three plans that we discussed are specific to small business owners, but if you are an individual operating as a sole proprietorship, you can open up one of these to help you with your retirement. Traditional IRA contributions are going to be made pre-tax, Roth are made after tax, and that's going to come into play when distributions begin from your plan. Now, with any of these above plans, the dollars contributed may be considered business deductions on your tax return. So you need to consider the type of plan, the type of contribution, and any limitations. So these, again, are going to be those detailed discussions with your tax accountant. but this is a great way to try to limit your tax liability while saving for retirement and having a nice benefit program.
Noelle, on the topic of retirement plans and possibly even health plans, is that something where a subchapter S election is relevant?
It is, yes.
Yeah.
So if you are an S corporation and you are the owner or the member, a lot of these premiums are not going to be tax deductible because they're just not considered a tax deduction for the business because you are the owner. You're not an employee and you don't sit behind the shield of a C corporation where it's a separate legal entity.
Yeah, I just wanted to sort of point that out as something that could be relevant if you're wanting to do one of these things too. And I was just also going to point out on the retirement plan slide that at least there was some period of time in 2021 where the CARES Act allowed business owners to take money out of their deferred plans without a penalty, and also to pay that back over a 3-year period of time. So if you were one of those people that did that in 2021, before you pay it back, you may want to talk to an accountant to see, whether it qualifies for one of those special distribution programs, and you can extend the time to pay it back.
Absolutely, yes.
And Noelle, sorry to cut in again. I'm gonna actually bring up this question we just got because it's regarding retirement plans, excuse me. But Steve asked if you start with an SEP, can you start with an SEP and then change it once you start bringing on employees or 1099 workers?
Yes and no. So it's fine to start with an SEP. Some of them you can morph and change into other plans. Others, they would require you to kind of, freeze it and then ultimately shut it down, if you will, before you would start investing and bringing up a new plan. So again, it depends on how it was set up initially and some other considerations, what type of business organization you have, because maybe if you had an SEP IRA and you were a single owner operating as a single member LLC, and now you're bringing employees on and you're switching, you're becoming a corporation and electing S status, that could also play a factor. So that's not a question I can answer with 100% certainty on the line right now. That would require some additional just follow up and understanding of your specific circumstances.
Too many factors.
Yeah.
Thanks.
Mm-hmm. So another great option is to provide health insurance. Oh, I took my page away that I need to have some of my notes on. There we go. So offering health insurance is going to be that great way to attract and retain top talent. Additionally, that Affordable Care Act, or ACA, requires that any businesses with 50 or more employees, that you have to provide affordable health insurance to your employees. So if you do have a considerable number of employees, you're going to have to provide this program anyhow. But premiums, and as we talked about, and actually there's a bullet point right on here, premiums paid for your employees are 100% tax deductible. However, health insurance premiums paid for the small business owner are not going to be tax deductible if you are in the position of S status with a corporation, as well as I think some sole proprietorship pieces. But that again, there's a lot of factors to consider whether it's how that all works. Not enough time on this particular conversation to talk about that specifically, but if you have more detailed questions on that, I will certainly be willing and very excited to help you out after the webinar is over. A bunch of different health insurance options. You can pick a small group insurance plan. You can have a self-funded plan, and there's health reimbursement arrangements, or HRAs. The small group insurance plans, those are going to be the typical ones you hear about. That cost is spread out amongst the whole pool of people. You as the business owner decide how much you're willing to contribute, and your employees offset the rest of the cost through payroll withholdings. You can also purchase these small group insurance plans through the shop exchange, and we're going to talk about that in more detail on the next slide. But these plans can become very expensive. Premiums can increase drastically year over year, and there's participation requirements to be mindful of with this type of plan. A self-funded plan, essentially you're paying your claims out of pocket. Typically, larger organizations are more excited about these types of plans because they have a separate trust or fund set up to the side where they stockpile a lot of cash. They're earning interest or some other ways of money coming in to that fund, and they're able to free up some cash flow. However, this is a much more risky option. So, maybe not an option you want to pursue, but it is available to you. And HRAs, this is a great affordable alternative to traditional insurance plans. This model is going to operate like a reimbursement. Your employee visits the doctor, pays for the visit, and then submits for that reimbursement to the employer. You decide how much you're going to load into their reimbursement account, and the employee can then take up to that max amount on an annual basis or quarterly basis, whatever has been determined in the arrangement. This is also great because 100% of the contributions and reimbursements to the employee are tax deductible to you and your business. And this also doesn't have a payroll tax implication because it's all operating outside of that W-2 world. So you don't have those extra costs to pay, and the employee gets a benefit by not having to recognize this as income in their W-2 wages. So, and as I mentioned before, the premiums are going to be deductible if you're paying for employees, and there's some cases if as you as the owner can get some deductibility, but those are not if you are the small business owner in an S status corporation. All right, so there is right now a small business healthcare tax credit that exists. You have to be an employer where you have fewer than 25 full-time equivalent employees. You have to pay these employees an average wage of less than $56,000 per year, which is indexed for inflation. And you have to offer a qualified health plan to employees through the Small Business Health Options Program Marketplace, or that SHOP Marketplace. And you have to cover at least 50% of employee-only health coverage cost for each employee. If you hit all 4 of those requirements, you are eligible for this credit. The maximum credit available is 50% of the premiums paid. And this is going to be available to you for 2 consecutive taxable years. And the great thing about a credit versus a deduction is this is a dollar for dollar amount directly against the tax liability that you owe, not just a deduction to reduce your taxable income, but this goes directly against your tax liability. The other great thing about this credit is it can be carried back or forward to years where your business has tax liability to offset. So definitely want to discuss this in depth with your tax accountant. This is just simply an overview to alert you of its existence. Okay. And I'm going to start maybe speeding up just a bit because I see we're running so close on time, and I want to make sure to at least cover high level things and have some time for Q&A at the end. So that Taxpayer Certainty and Disaster Act Relief Act of 2020 that was passed in December in direct response to the COVID pandemic provided for a number of expanded tax benefits that we're going to highlight here. So it generally extended through 2021 for temporary tax changes or benefits. 2 of them are related to individuals and 2 are related to businesses. So essentially for the individuals, it all revolves around cash contributions to charitable organizations. If you do not itemize, you're still eligible to claim a deduction of $300 if single or $600 if married filing joint. Right on the front of your 1040 to help reduce your adjusted gross income. If you do happen to itemize, you're no longer subject to the AGI or adjusted gross income limitations. That's been raised to, there's 100% on that. Now these do have to be cash contributions, so cash, check, or credit card, not the value of volunteer services or property items that you may have donated. C corporations are eligible to take advantage of the charitable contribution limit increased to 25% of taxable income instead of the 10% that it had been. And any business there are increased limits on amounts deductible by businesses for certain donated food inventory. So if you've donated food to help care for the very sick, elderly, or infants, you're not going to be subject to a lot of those limitations. Those limitations have been increased so that way you're able to get more of a benefit for the good that you've done. All right, we're supposed to have a poll question, but to be honest, I'd rather keep going with the information I want to share. So unless someone really wants a poll question, you can yell at Anna if you really want a poll question, and then she'll let me know and I'll put them up. Okay, buying and selling a business. M&A activity slowed way down in 2020, obviously, but analysts are predicting that this is going to experience a big bounce back in 2021 and into 2022. So you want to be mindful of it if it's something you're interested in doing. Right now, a transaction under current tax law can be structured in one of two ways, either a sale of stock or the ownership interest in the business, or an asset sale. Now, a stock sale, that's where a buyer is purchasing a seller's interest. If you're a C Corp or an S Corp, or if you're an LLC or a sole proprietor, there's still an ownership interest in there. That's going to be an asset sale. Getting all confused because I'm seeing the clock. Now, these current tax rates make buying and selling very attractive to individuals, to other organizations, but that could all change, as we know, because the tax climate is ever changing. So you want to keep that in mind as well. There's always going to be some tax implication, and buying and selling is best to do when these tax rates are low, because as you're recognizing those gains on the purchase or sale of the business, you want to limit your tax liability as best as possible. So considerations if you're looking to buy a business. Now, buyers are usually going to prefer to buy assets of an organization or business instead of the ownership interest. Buyers need to be concerned about limiting their exposure to undisclosed or unknown liabilities, as well as minimizing your taxes. Now, keep in mind, buyers can increase their tax basis of purchased assets to reflect that purchase price. So that means you're going to get a step up in basis. You're not going to be held to what those assets were valued at with the previous owner. You're getting a new value. So that's going to lower taxable gains when those certain assets like receivables and inventory are sold or converted to cash. And it's also going to increase those depreciation and amortization deductions for those qualifying assets on your business return. In general, a buyer's primary goal is to generate enough cash flow from an acquired business to pay any debt and provide an acceptable return on the investment while limiting your overall tax exposure. A few more considerations if you're now the seller. Now, sellers are usually going to prefer those stock sales for both tax and non-tax reasons. And your main objective when selling a business should be to minimize that tax bill. Again, you've enjoyed a successful business. You don't want to be subject to paying it all out in taxes to the government at the end. 3 critical things to keep in mind when you're selling your business, even from a non-tax perspective. Make sure your business financial records are in order and readily available. Put that buyer's hat on. Make sure you're not just focused on one number. I have to get $5 million for my business. Think about what the value your business has for that buyer or any potential buyer, and definitely maintain status quo. Businesses or transactions can take a long time to go through, and some deals just never happen. If you allow distractions to get in the way, your business could potentially lose value, and it could have other tax implications that you don't want to open yourself up to.
Yeah, I was just going to make a real quick comment on that. From the buyer's perspective, sometimes folks have a misunderstanding about limiting liabilities whenever they're buying a business in an asset sale, that the agreement is going to do all of the work for them, and it typically does not. So it's really a good idea to do your homework in advance and kick the tires and do a lot of due diligence to go into it with your eyes as wide open as they can be. So that's just something that an attorney can assist you with, to understand all of the things that happen in a transaction that are outside the 4 corners of the document. And there's typically an agreement between the parties on how to allocate the purchase price for tax purposes, so that you're both reporting it the same way. That's not always the case. And if you're an unknowledgeable buyer, you might not know that those possibilities, are out there. From the selling perspective, I think sellers sometimes misunderstand how important it is to have their books and records together in a format that is not only something that the buyer might be looking for, but sometimes buyers are unsophisticated, so they don't know what they're looking for, but you'll want to have them in a format that's appropriate for the lender that might be lending money into the transaction for the buyer, that they're going to want to see them, and also for the accountant. So it's important, if you want to be thinking about selling your business in the next couple of years, to sit down with your accountant and say, how is a bank going to look at this business for purposes of deciding to lend money into the transaction on the buyer side? What do I need my books to look like? What do we have to change? How do we have to clean them up so that they are something that the bank wants to look at, right? Because maybe what you want to show to the government from a tax perspective isn't necessarily the same thing that you want to show a lender to make your business enticing from a loan perspective to sell the business. You just have to understand how those things work for you. So.
Absolutely. Yeah, great information, Mike. And we just have 2 more slides here. So I do just want to touch on these because these are important. So some helpful tips to reduce your taxable income in the right way. We don't want like Elliot Ness chasing down Al Capone for tax evasion, even though that happened so many years ago. I always hear about it everywhere, and it's such a story that's marked in my brain forever. But monitor your adjusted gross income, or AGI, on a regular basis. So many tax breaks, limitations, deductions, and additional taxes are based off of AGI. So if you're monitoring this consistently and aware of those related tax implications, it's going to help ensure you are taking advantage of the deductions and credits available to you and your business. Be strategic about your business expenditures each year and make the most advantageous tax elections for your business. If you're going to be, making equipment purchases or charitable contributions, it might be helpful to bundle these in certain years to get the most impact of those available tax deductions or credits, as well as determining how those tax rate fluctuations could work to your business's advantage. Don't forget about those carryovers and the carrybacks. Make sure that you're having those conversations with your tax accountant so those are still on everyone's radar. Things like capital losses, charitable contribution deductions, general business credits, the home office deduction, and net operating losses all can be considered here. And finally, use tax-free ways to extract income from your business as the owner. Retirement plans, medical coverage, health savings accounts, or even things like low interest loans from the business are all ways for you to get cash out of your business tax-free. All right. So we've talked about how to limit those tax liabilities. What happens if the tax time comes and you just don't have the cash to satisfy that amount owed? What do you do? Well, just briefly, there are going to be a ton of different penalties that the IRS could potentially assess. Failure to file, failure to pay proper estimated tax, failure to pay if your payment doesn't go through because your bank institution messed up. These can go anywhere from 0.25% to 5% of the tax bill and accrue monthly, sometimes with interest applied each month. So these can get big and unwieldy very, very fast. So what should you do? File your return on time anyway. This may trigger a late filing penalty, but that penalty is going to be much lower than a failure to file penalty. Make at least a partial payment and try to obtain an affordable payment plan on the balance. This is going to help reduce any of those penalties and interest. Check out the available plans that the IRS offers for both a short-term and long-term, whether you're an individual or business, to help make payments on the tax bill owed. If you think you can maybe pay sometime in the future, but you just can't pay right now, see if the IRS will consider deferring your payments and put you in currently not collectible or CNC status. Now, there's going to be ways to qualify for this status, and the first way is they're not going to allow you to qualify if you have any returns that haven't been filed. So you definitely want to get all your filings in, but that is another option. And finally, if none of these are available to you, you can also try to settle unpaid taxes with an offer and compromise. Now, this is a program that's going to allow a taxpayer to settle for less than the full amount owed, but they have to meet strict IRS criteria. That's going to be kind of your final option. So just want to give you this, 60-second high-level key point takeaways of everything we talked about. There are several small business tax deductions and credits available to all types of businesses to help you reduce your overall taxable income and your resulting tax bill. Ensure you are discussing these matters routinely and consistently with your tax accountant because these rules, laws, and regulations constantly change. You don't want to miss out on that potential to lower your tax bill. Also, there are tips and tricks to put into place, like annual review procedures to help reduce your taxable income, which is going to lead directly to a lower tax bill as well. If you're operating your business out of your home, the home office deduction can be a valuable tax break that you may be missing out on. It's definitely worth it to determine eligibility and maintain good, clean records and documents to take this deduction if you can. The Taxpayer Certainty and Disaster Relief Act of 2020 did extend a number of benefits for individuals and corporations into that 2021 tax year. So have these on your radar while you're finishing up fourth quarter and planning out your 2021 return filings. Tons of considerations around buying and selling a business. Definitely want to get all of your business consultants, attorneys, and accountants involved before you make any decisions on whether to proceed with that or not. And finally, there are several options that exist to help with outstanding tax liabilities when cash is tight or non-existent. Be sure to seek that professional advice if you're in this situation so that you're making sure for it to be resolved to your advantage as best as it can. That's it. I know we're over. I'm so sorry. I'm going to try to bump back over here.
So quickly, Noelle, while we kind of like open this Q&A, I'll start out first with 2 questions that I had kind of archived for you. And then I know that we're at past 1 right now, so if anybody needs to go, that's totally fine. But I'll just mention quick that we're going to do a follow-up email to everybody that attended. So you will be able to kind of play this back, get Noelle's contact info, and have a way to kind of look back at some of the things she mentioned, or a way to get in touch with us if you'd like. But first, this actually was pertaining to the home office deduction, but I think we were moving along at that point a little bit. But someone had a question on the max usage of the 300 feet for the like percentage of the actual area to the house. And I believe he can, if he wants to elaborate more, if I'm not saying this right, he was wondering what is the maximum, is there a max dollar amount? So if max usage is up to 300 square feet, is it like a capped amount for money as well?
Yep. So that 300 square foot is only if you elect the simplified calculation. So if you elect that, you're going to take your square footage amount, which you cannot exceed the 300, multiplied by $5 per square foot. So the max amount would be a $1,500 deduction. If you decide to do the full calculation, you're not capped at either a square footage or a dollar amount. It's based on actuals.
Perfect. And then I also actually might need to tag you in a little bit too, Mike, on this one, but somebody had a general question on, I guess we can sum this up to maybe just a couple or like maybe one great question each for you guys, but what type of tax questions should I ask my attorney? And then what type of question should I ask my accountant or my bookkeeper?
Well, that's a toughie. I would say that most often the question that I get most frequently from small business owners, especially ones that are starting out in their lives, is should I file a subchapter S election, and what business entity can I use to file a subchapter S election? So, and I know that there's a question about that floating around in there, and maybe we can do one of these webinars that is really kind of drilled in on subchapter S related matters. But I do think that there are some conventional wisdoms about when a subchapter S election is something that you should think about doing. It's not necessarily relevant for somebody that's forming a business from the get-go, but it probably is as they start to have some income and expenses and employees, then you really need to think about it. The good news is that you can elect subchapter S status at the beginning of every year before March 15th. So you get to revisit that every year. It's not like a forever type thing. Like if you missed it, your business is doomed to no longer be a subchapter S for the rest of its life. But that's one that we talk about quite a bit.
Yeah, and I think from an accounting side, pretty much tax deductions and tax credits, that's where you'd want to focus your questions on to your tax accountant.
And I had one more come up when you guys were explaining that on quickly touching on auto mileage deductions and just the best way for somebody that's using their car for both personal and business needs. Like what's the easiest way to document, which I'm sure this is not a quick answer.
So this has a lot of caveats. It depends on a couple things. One, if the car is yours personally, you want to track it either in some type of logbook where you're maintaining good, clean records of here's the mileage that I'm driving for business reasons only. Keep track of, what the business purpose was. And then you can use there's again, two calculations, one simplified, one actual expenses. If that vehicle is yours personally that you're using for business, you can elect either one. If you're doing the mileage, you're keeping track of your miles in the logbook, you're multiplying that by a cents per mile, and that is the amount. If you're doing actuals, you're going to have to keep receipts of tire changes, oil changes, pretty much everything you've paid for your car. Figure out your personal mileage versus your business mileage and take that percentage. So it's similar to the home office deduction. However, if you're driving a vehicle that is owned by your business, you cannot take a mileage deduction because the company is taking all of those deductions. And what you should be receiving is, if you're driving that at all for personal reasons, that should be layered into your W-2 income from your business. So that was a lot in one question.
I think thorough in a good way. We are actually, how about that? We will stay on a little bit longer. The three of us will kind of hang out and keep looking at the question, the chat pod, if anybody else has any last second, maybe more specific questions that they were maybe too afraid to ask while we were chugging along earlier, but please feel free to bring those up now. But if you need to get back to it, thank you so much for joining us. We really appreciate it. And like I mentioned just a little bit ago, we are going to send a follow-up email to all attendees with a playback link on Fiffik's YouTube. If you want to watch this back or had any second thoughts about what did Noelle say at that point, like I need to check that off and ask my bookkeeper about that. So there'll be a link for that, and then a survey for us to get some feedback and contact information, a way to reach out if you guys have more questions and you would like to learn more.
Yes, I've definitely shared on previous webinars that my kids love watching these on YouTube, and they start, saying the stuff back to me. I've noticed that some of these webinars actually have ads now. So many times my kids have watched them, they're hitting like that 200 or 250 views. And now when I go back to try to remember, what did I talk about? I have to sit through an ad. I'm like, are you kidding me?
Oh, no.
Noelle, I actually have
another one.
That's also a record. I don't know if we have any ads on ours yet, so I'm a little bit jealous. But I actually do have another one that was a specific one for earlier that I saved from Steve.
Okay.
But he had a question about Office 365, and he had paid for 2 years, and he's wondering if he should amortize it and take the 2-year amount since he paid in advance, but it will need to be renewed.
So this is where it gets into book versus tax accounting. So if you keep your books on the accrual basis of accounting, yes, you would be recognizing that expense through the life that you are consuming that service. So over those 24 months. However, your tax return is prepared on the cash basis. The IRS cares about what cash came in and what cash came out of your business. So if you paid for the full 24-month subscription in October of 2021, and it was, let's say it's $5,000, that $5,000 is eligible for the tax deduction in 2021. However, when you keep expensing that on your books in 2022, keep in mind you've already taken the full deduction from the prior year. So there is not going to be a further deduction for you to take in 2022.
Ouch, my head hurts.
I love talking about this stuff. I don't want to stop now. I see that Jimmy mentioned in the chat that he has a challenge of keeping track of the mileage to put in his logbook. That's a challenge experienced by, I would say, 99.9% of individuals. It's you never think about that logbook. There are apps that exist that are right there on your phone that you just boop, 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 key it in, it's done. Even apps, if you really want to get totally connected, where it'll just track how far you've driven in your car. You just turn on and say, yep, I'm going on my trip now. And then you stop it when you get there and it's already doing it for you. Some you do have to pay for. I think there's some that are free, but they're not as intuitive or as sophisticated. But that's an option that a lot of people have gone to not have to think about doing it later in a logbook.
Yeah, you would think that the auto manufacturers that would just build that software right into the car, right, as a value-added feature. You know what I mean? You can just tell your car, I'm starting, start counting, right? Just like your Alexa.
Track it. Yes, exactly.
Or your Google.
Jimmy, you know what? He asked if there's a certain app I'd recommend. Whatever you feel most comfortable with. There's the ones that are available either in the Apple Store or on Google Play. As long as they get that green check that they're okay, I haven't heard any complaints about any of them. I personally don't use any of them, so I can't speak from personal use. But all the ones I've seen other clients use, pick your flavor. Yes, I've heard very good things about Mile IQ. You are absolutely correct.
And Noelle, I think we'll probably wrap up pretty soon, but I had one more I wanted to bring up to you that was towards the beginning. Steve asked, he said, I just started my coaching business and I got my fictitious name, but I have not incorporated as of yet. And he's using his SSN as his tax ID. And he's wondering when he takes things to the next level, example, should he become like an S Corp, et cetera? And is there a revenue like plateau that I should make the move for?
There's really not. It's what's your appetite for risk and what's your appetite for how much of the business you want to keep control of. And actually, Mike, you're right. This dovetails exactly into that whole business organization structure webinar we did. Oh my goodness, several months ago now.
March feels like a lifetime.
Oh my gosh. So maybe that'll be a great one for us to redo in 2022 since there's all these questions. But yeah, it really depends on a lot of personal factors with that. If it's a sole proprietorship, you're bearing that whole risk on your own. You're going to be personally liable for everything. If you're not ready to pay wages just yet, you don't want to elect that subchapter S for a corporation because as the business owner, you're required to take a reasonable salary. So if you don't have cash to start paying a salary, you're going to be subject to different tax structures that could get a little messy if you elect that too soon. So it's all just dependent on how things are going, what's your appetite for risk, how quickly you think you're going to move into where you need to have, you have a bunch of customers, you have a bunch of vendors, you're going to be putting stuff down on paper, all of that. It's really dependent on.
Yeah, and you can mitigate risks in lots of different ways. Having a limited liability business entity is one way of doing it. It's just that it's not going to shield you from risk that arise from your own personal actions. So I don't know what kind of training or coaching that you're doing, but if your coaching involves a lot of your own personal action and you've committed some type of a tort or whatever that causes somebody injury, having no LC isn't going to protect you from claims arising out of that. So that's a good conversation to have with your attorney about how to mitigate risk.
Yes.
Well, those are all great questions. And thank you very much all for the feedback. Noelle, it was a great presentation. As always, you always bring it. So there's you never disappoint. So your kids will
Thank
enjoy
you.
this webinar as they
Start getting
view
ad
it
revenue on
1,000
YouTube
times.
videos.
So we appreciate that. Tell them to leave good comments. If they're going to be watching it, they can at least leave good comments, right? Give
Yes.
some thumbs ups and all that stuff. So thank you all again. We do have some other webinars that are scheduled, and I think we have one next week on estate planning and protecting your family with estate planning. So please check that out on our Eventbrite page. Donnelly-Boland does presentations as well, if you want to check them out as well on various topics. We aren't their exclusive means of doing presentations out there. They do some otherwise. These are just a little bit tailored for our audience. So we thank you, everybody, and we wish you all a great rest of your week.